today we have with us here Mr. Clarence Chee, right? He's actually the veteran trader and in fact trainer as well in the FX market, in trading indexes, stocks, CFDs and commodities even, right? And today is our honor to have him with us, that we want to find out a little bit what is the current market outlook. So maybe Clarence can share with us, especially the, I think latest hot market, is it the US stocks?
I think it's basically it's affecting the global stock market. You see what happened in the, we talk about stock market first before we go into forex. The stock market right now seems to be undergoing a very steep correction. So it's very possible that this steep correction may lead to a temporary bear market. So some of you, if you have been following the news in CNBC, Bloomberg, you will know that the root cause of this steep correction basically is because of the rising US Treasuries yield. So it is not just the US Treasuries yield, but also other sovereign bond yields, include the Euro bond, the British bond, and even the Japanese bond. The reason why these bond yields are rising is because of the debt level. As you can see, because of the last year, the COVID-19 pandemic that has caused the global economy to go into a recession. As a result, the government all over the world has been spending a lot of money to so-called to help the economy to recover. And most of these so-called Western countries or the developed countries, you find that they are not like Singapore, because Singapore government, we have reserves, so we tap into the reserves. For them, they go into debt financing. So they got to issue more bonds, to finance the expenditure, so that they can spend to revive the economy. Now the problem with this is that when they start to sell a lot of bonds, and in order to attract investors to buy the bonds, to accept the bonds, they got to sell the bonds slightly with a higher yield. With a higher yield. So this is in order to make it attractive for investors. So because of this higher yield, what happened? The yield start to go up. And when the yield start to go up, it go up to the level where it's on par with the average S&P 500 dividend yield. So when this happens, investors will start to question themselves, why would they want to buy a stock to enjoy the dividend yield when they can easily buy the bonds to pay them almost the same amount of yield. And plus the bonds are guaranteed by the government, because they are issued by the government. So because of that, they start to unload the stocks, especially the tech stocks. Reason tech stocks don't even pay any dividend. Just to let you guys know, in case some of you may not know, most tech stocks in the US, they don't really pay dividend. This is the reason why the capital gain is tremendously high, because they don't pay dividend. So because of this, what happened? Tech stocks also get back, because they got no dividend. Most tech stocks don't pay dividend, so they get wrecked. So because of this, you find that, and another thing is because rising yield is also an indication of potential rise in inflation. So any rise in inflation will eventually lead to a rise in interest rate, which the market doesn't like. You see, you must understand the market has been spoiled by the central banks, because every time that the market all these years has been depending on the central bank to pump liquidity into the market, so as to save it, So this time around, what happened is March last year, when the market tanked because of the COVID-19 pandemic. As a result, you find that the Federal Reserve was the first central bank to come in to lower interest rate and start to implement QE. And they went to the extent of implementing unlimited QE. And then this was followed by Japan, the European Union, even the United Kingdom, everybody including Singapore. Singapore got no QE, but Singapore government has already utilized past 20 years of budget surplus. So Singapore is also, the government is also spending a lot of money. So because of this, you find that the opposite actually, the impact actually becomes opposite, which means that last year, when the economy starts to go into recession, the stock market recovers, right, from the March 23rd low. Now, as this year, as the economy recovers, the stock market becomes very nervous, very worried about the rising interest rate, which is very natural, right? Because rising interest rate or increasing inflation is the result of the economic recovery, which the market doesn't like. See, as a result, the stock market tanked. Okay, as a result, the stock market tanked. So with the rising treasuries yield, what happened? It actually caused the US dollar to appreciate. It caused the US dollar to appreciate. So you find that the dollar, which is supposed to be weakened because of the debt level of the US government, has instead strengthened. And then you need to talk about crypto also. Crypto, I think yesterday came down quite a bit, quite a lot. In fact, it came down to 46,000 level from above 50,000. In fact, this morning when I looked at the chart, it actually continued to come down. Now let me explain why crypto is coming down. Because over in the stock market, because the Nasdaq tanked, Nasdaq already year to date negative, negative territory. Because of the stock market tank, what happened? A lot of people get margin call. So when they get margin call, they are forced to sell their crypto, to cash out their crypto, to use the cash to top up their margin call over at the stock side. So that actually trigger a snowballing effect on the crypto to come down. So don't be surprised the crypto will continue to come down for over the next few days. As at today, what day is today? March 5th. Okay, today is March 5th, 2021. Okay. So overall, what we see is that stock market is down. US dollar is up. Crypto is down. Definitely gold and silver also down, because gold and silver has no yield. Okay, gold doesn't pay any interest, no dividend, so there's no point holding on to gold. Plus the US dollar has strengthened, so usually gold is inversely correlated with US dollar. So that is a double whammy for gold and silver coming down. I think gold expected to break below 1,007.
Wow.
Yeah.
Okay.
So there are opportunities. You can always short indices. You can always short the stocks using CFD. You can long spot forex, right? When I say long, means long the dollar, especially dollar against Japanese yen, or dollar against Swiss francs, because Swiss francs is very weak now. So there are still opportunities. So you can also short spot gold. So there are opportunities if you know how to read the market. Yeah.
Right. Wow. Thank you so much, Clarence, for giving us an overview, of the market outlook. And I'm wondering, the market outlook that you are giving us some perspective is how long would this, this situation?
Well, I think it's going to be quite some time, because Jerome Powell, I think early this morning at 1:05 a.m. Singapore time, he addressed the Wall Street. Can't remember which committee. It's something organized by Wall Street Journal. This is the third time. This session is the third time that he tried to convince the market to come down, which he failed. In fact, it became worse after his speech. Nasdaq, Dow Jones all came down even faster than before his speech. The first two attempts to calm down the market was during his two sessions of testimony to the Congress, which again he failed miserably in assuring the market. Even though he said that the Fed will not increase interest rate, or rather will not start to increase interest rate unless inflation exceeded 2% over a period of more than 2 quarters. That should be quite assuring to the market, but to the market it's not good enough. So now this morning at 1:05 a.m. he gave the same speech, trying to assure the market, and it failed again. So after 3 attempts he failed, so I think all hell break loose. And this morning straight away you can see the 3 US stock indices all came down, and I just saw Bloomberg, the China CSI 300 index dropped more than 10% this morning. So it's not a good news for a global stock market. But surprisingly, year to date, STI, that was yesterday, before the Jerome Powell gave the speech. STI actually outperformed China stock indices. STI outperformed Shanghai, Shenzhen.
I see.
So still got hope for Singapore.
No, I was about to ask any reason why this STI.
Okay, because China has been, okay, we talk about China first. China, because I think some of you will know that China is currently at, yesterday, if I'm not wrong, was the first day of the parliamentary session where they're going to map out the next 5 years economic direction, you know. And also China has been very careful regarding pumping liquidity into the market. In fact, now they have already started to limit or restrict liquidity in the market because they are very sensitive to debt level. Why? Because they are communists. They are not fully capitalist, so they are communist. So they don't believe in unlimited debt, like the US. So they are very careful with leverage. They are very careful with the debt level of government spending as well as the leverage used in the financial market. So they have started to restrict or limit the amount of leverage as well as liquidity in the markets. That's why you find that the China stock market has not been doing too well this year. Even though last year, China economy did very well because they actually are in the positive region, right? Economic growth positive, while the rest of the world went into a temporary recession. Now the only country that outperformed China in economically is actually Vietnam. Yeah, Vietnam, because Vietnam 4 quarters last year is all positive growth, and Vietnam COVID-19 zero death. But I don't know how true is the data.
Okay.
So you need to go and check with Ho Chi Minh.
Okay, that's interesting. Right. And thank you so much for sharing with us these great insights, right? And let's take a coffee break and come back shortly.
Subscribe to our YouTube channel and click the bell reminder so you won't miss any special monetization opportunities. Go follow now.